everybody, Gbenga Olatunji here, welcoming you to GJAMESASSOCIATES channel. We are looking at corporate reporting overview. Today. Here we'll be breaking down everything that is expected of us to understand about corporate reporting. We'll pay attention to the breakdown of corporate reporting. We'll pay attention to those IASs, those IFRSs that are examinable, so that we will know the area of concentration that we need to give attention to in our syllabus. Even though everything is important, we will look at the background that we are coming from and those courses that we need to be strong at, so that we can pass corporate reporting easily, and those courses that corporate reporting lean on. The main competencies expected of us will be looked at, the breakdown and the weighting of our syllabus, so that we will not major on the minor or minor on the major. Then after that, we will go into detailed breakdown of the course and the topics and jugulars that are expected to be learned and understand, so that we can pass easily corporate reporting. Then after that, the next video is going to be on the director's list of items that they must report. Director's list of corporate reporting items. So let's begin to take it a step at a time now, looking at the background, those courses that we need to be strong on, which by now we will have known and experienced. We must be strong in financial reporting from the background of financial accounting. So for successful ride on corporate reporting, is important that we are strong in financial reporting. Also, business law is important to this course. Financial accounting, like I said, is important. Taxation is important, and advanced taxation is important. Having these strengths will enable us to easily pass corporate reporting. The main competencies now that are expected of us, as at this level now, it is expected of us to be able to interpret, to be able to prepare and report on financials, to be able to deal with complex single entity, complex group financials by now, and to be able to prepare financial statement for any, just name it, any organization. We should by now know what type of information should be in their financial statements. Those are the things that we need to have main competencies on. Also, by now and at the end of us writing corporate reporting, we must have known and be able to implement and suggest suitable accounting policies for our organization. Suitable accounting policies for our organization, we should be able to advise and implement accounting policies now. By now, we must be strong on interpretation of financials, analyzing the financial statements, and we must be able to evaluate financial information and also know necessary disclosures and level of disclosures expected of our organization. So preparing, analyzing the financial statements for corporate organizations, for managers, for the board of directors, at this level, we should be able to handle it, to show the position of the organization in form of performance, in form of prospects, and even the risk management side of the business. We should be able to handle it by now. At the end of corporate reporting, we should have learned and have this as our main competence. Also, we must be able to understand current issues in financial reporting and reporting framework in corporate world. Also, we must be able to assess and understand creative accounting, its implementation, its effects, and what we need to do to guide ourselves and anyone around us against financial creative accounting, aggressive earning management, and the like. Looking at the major breakdown now, corporate reporting, which we normally call usually CR, is broken into 5 major parts, and regulatory framework and ethics is part A of corporate reporting. And basically, ethics have been spread abroad in all of our courses just to ensure that we are ethical and we inculcate it. So no professional can survive at long run in its profession, name it, not only financial, without having ethics at the back of our hearts. The second part, the big part of our of CR, is reporting of entities' performance to stakeholders. And by the way, the part A carries 10 of the weights in form of percentage. So it's 10% of corporate reporting. And the B part, reporting of entities' performance to stakeholders, carries 20% weight. And I want to believe by now anything about stakeholders, we understand the difference between stakeholders and the shareholders and the like. Major parts of corporate reporting at this level is reporting on complex organization, usually group financial statements. The minority shareholder, the majority shareholder, the subsidiary, the associate, how to identify them, how to report them, the disclosure and the like. Group financial statement carries 30% of corporate reporting. Then the D parts, we'll be talking about the current developments in the world of finance, accounting, current developments in and beyond financial reporting. So we must know the current developments in the industry as it relates to our company, as it relates to our industry, as it relates to our country, as it relates to the world at large of finance and corporate reporting. It carries 20 weight. Last but not the least is analyzing. We must be able to analyze and interpret our entities' financials very well. So we'll be talking about analysis of financials and other reports to appraise entities' financial performance and position. So this carries 20% of corporate reporting. 20% of our corporate reporting it carries. So it is broken, major parts broken into 5 parts, A, B, C, D, E, and they have different weights, and we must be able to allot time to them so that we are not going to major on the minor or minor on the major in preparation, in study, and the like. What are the examinable IASs and IFRSs at this level? Don't forget that from the background of financial accounting, financial reporting, we are used to a lot of IASs, IFRSs. But now, some of them will be repeated and are examinable, while some will not feature for at this level. So what are those that we must be strong on for corporate reporting now? IAS 1, which is about financial presentation of financial statements. It looks simple, but we all agree we must be able to present very well financial statements and know the standard requirement for us to when it comes to disclosure and presentation. So IAS 1 is highly examinable. So we say yes to is examinable or examinability. IAS 2 deals with inventory, and we are used to all those inventory types and the like. So no to that. That does not mean, let us establish one thing. When we say no to an IAS or IFRS, we do not mean that we should not read on them. After all, we must have learnt them before we got to this stage. But nevertheless, we are pinpointing those ones that we should expect. Then IAS 7 that deals with cash flow statements is highly examinable. Another highly examinable one is accounting policies, change in accounting estimates and errors. That is IAS 8. Another one that we should expect is IAS 12, which deals with income taxes. Another one that we should expect at this level to come out is IAS 16 on property, plant and equipment, PPE. Another IAS to be expected in the examination is IAS 19 on employee benefit. Another one to be expected is the effect of changes in foreign exchange rates. We say yes to that too. IAS 24 that deals with related party disclosure at this level, those are the complexity in financials. Yes on its examinability. IAS 26 on accounting and reporting by retirement benefit plan, we say yes to it. And IAS 27, which is on separate financial statements, is highly examinable too. Another one that is highly examinable is IAS 28 that deals with accounting for investment in associates and joint venture is highly examinable. Financial instrument presentation, which is IAS 32, is highly examinable. Earning per share, the standard that deals with earning per share, IAS 33, is highly examinable. IAS 34 on interim financial reporting is highly examinable. Another one that is highly examinable is IAS 37. IAS 37 deals with provision, contingent liability, and contingent assets. What are all those things? They are highly examinable. Another one that is highly examinable is IAS 36 on impairment of assets. Is highly examinable. Then we move on to IAS 38. IAS 38 talks of intangible assets. Highly examinable. IAS 40, which relates with investment property, highly examinable, and agricultural standard. IAS 41, yes to IAS 41 on agriculture is highly examinable. Having worked on IASs, let us look at examinable IFRSs. Examinable IFRSs. So we'll be talking about the first time adoption, IFRS 1. We'll be talking about share-based payments, IFRS rather 2, IFRS 3 on business combination, and that one too is a bit complex, highly examinable. On non-current assets held for sales and discontinued business or operation is highly examinable. Yes to IFRS 6 also on exploration for an evaluation of mineral resources, highly examinable. Another one that is highly examinable, we'll be talking about IFRS 7 on financial instruments and disclosure aspect of it, especially highly examinable. IFRS 8 is equally highly examinable, that relates with operating segment, is highly examinable. Then we'll talk about IFRS 9 that deals with financial instruments. Yes to IFRS 9. Then IFRS 10 on consolidated financial statement. I know that you know that yes is the answer to the examinability of consolidated financial statement at this level. Another yes is for joint arrangements, IFRS 8. IFRS 11 rather. IFRS 11 deals with joint arrangements and is highly examinable. Basically, while we are running ourselves through those IFRS and IASs that are examinable is to concentrate our energy when we are reading, because majority of us are working and we need to conserve our energy and know how best to approach our studies. And don't forget that those ones that we are not actually saying yeses to, we had looked at them or learnt them at different stages before we get to this level. Then another one that is highly examinable, having said that, is joint arrangement, IFRS 11. IFRS 12 deals with disclosure of interests in other entities, highly examinable. IFRS 13 too will be tested, fair value measurement, and recently there are a lot of new developments on this topic. IFRS 14 deals with regulatory deferral accounts, highly examinable. IFRS 15 revenue from contracts with customer, highly examinable, and we need to pay attention equally to this one, among other things. Just emphasizing in not that maybe it's that important, so that's okay. Then another one is lease or leases. You know, we have different kind of leases: the financial lease, the operating lease, the finance lease rather. IFRS 16 on lease is highly examinable, and that one now was recently touched on and updated too. Then we'll look at IFRS for SMEs. Don't forget that all these IFRSs that we've been dealing with are for corporate, for multinationals and big entities. So there's a brand of IFRS for SMEs. So we need to know them because we may work in SME environments. Also, the GAP, generally acceptable accounting practices, standards, and the like, especially when it concerns NGO, not-for-profit making organization, highly examinable. The answer is yes to is examinability, if there is any word like that. So having run through this, let us look at the topicals and topics and subtopics under them that we need to familiarize ourselves with as we prepare for the corporate reporting. Regulatory framework. We need to know about the International Financial Reporting Standard, just like we've run through it. Then we need in-depth knowledge of those IFRSs, especially those that are examinable at this level. Convergence of accounting standards. We need to know what is convergence and the like. Advantages and disadvantages of harmonization. We need to know international adoption of IFRSs, and are there some countries that are yet to adopt IFRSs, and what are the strengths and the like. We need to understand that. Still on regulatory framework, we need to know FASB and IASs work and their differences and similarity. Then we need to know the principle based and rule based regulatory framework, and we need to be able to distinguish between them. Having said that, we move on to the breakdown, jugular breakdown under regulatory framework, and we'll be talking about the source of regulation, accounting standards, those ones that we have mentioned already, must pay attention to them. International Financial Reporting Standard, the list of them which we had already run ourselves through, even the one that are examinable and non-examinable at this level. We need to know our Company and Allied Matter Acts that regulates organizations that we are preparing and maintaining their financial statement for. We need to understand the fundamental principles, fundamental framework, fundamental accounting concepts. We need to know the threats to our fundamental principles, accountants in business, preparation and reporting of information, potential conflicts. All these ones actually that we just mentioned, actually we had a video on them already. So if we are to summarize regulatory framework, we can summarize it under three purview. It looks at convergence with IFRSs. We must have that knowledge. It looks at accounting rules and principles, and framework, regulatory framework deals with ethics of the profession, the ethics of the profession. Then we move on to the next topic, which is on accounting and reporting concepts. And under accounting and reporting concepts, we can break it down into two major components: the conceptual framework and the accounting concepts. Then we are talking about the conceptual framework for financial reporting. We'll be talking about what's the meaning of GAAP, the meaning of conceptual framework, what is the purpose of framework that we have, and are there any alternatives to conceptual framework. Then looking at accounting concepts, we'll be talking about consistency in presentation. That should be under IAS 1. We're looking at materiality and aggregation, offsetting. When can we offset? When can we not offset? What is aggregation? Fair presentation. All this knowledge, they are very important and key to our understanding and professionalism. Like when we are talking about offsetting, it's so simple to fall into its error. But offsetting, say under IAS 1, is telling us that assets and liabilities should not be offset against each other, and similar income and expenses should also not be offset against one another. but we should separate them and report them separately. Of course, there will usually be exception to the rule, and those are the things that we need to go in depth and have in-depth knowledge under that topic. Then when we move on to presentation of financial statements as a topic, we'll look at IAS 1, IAS 34, IAS 24, and they deal with presentation of financial statements, interim financial reporting, related party disclosure. When we are talking of presentation of financial statements, we'll be looking at the form of businesses, the content of financial statement for different forms of businesses. We'll be talking about the financial statement position. We'll be talking about statement of profit or losses or loss and other comprehensive income. We'll be talking about SOHI, that is statement of changes in equity, and we'll be talking about notes to the financial statements. Notes to financial statements. Then when we are talking about the interim financial reporting, we have to cover the scope of IAS 34 and have an in-depth knowledge of it as it relates to the form and content of interim financial statements, as it relates to the period for which interim financial statements must be presented to the regulators, recognition and measurement of it, the use of estimates in interim financial statements must be understood, and interim reporting must be known, and the deadline as it relates to our country. Last but not the least on the presentation of financial statements is related party disclosure. Then we'll be looking at the impact of on the financial statements, that is related party transaction impact on the financial statements. What's the objective of IAS 24 as it relates to related party disclosure? What is the definition of related party? What can we say are related party? The disclosure requirement of transaction with related party. The impacts, like, are the transactions done at arm's length? What's the enforcement of the transaction? What's the level of enforcement of transaction if anything should go wrong, and the like, as it relates to related party transaction? Then we'll move on to the next topic, which is other information in the annual report. Other information in the annual report. And when we are talking about that, we'll be looking at the annual report itself, governance as it relates to reporting, management commentary, like the next topic will be on the list of directors reports, risk reporting, and other financial information that we need to present in the annual report. Then under annual reports, we'll be looking at the content of the annual report and voluntary disclosure, like those items on the list of directors. Majority of them are mandatory. The reporting of directors' reports must have and speak about them. But there are some disclosure in the financial statements that are not obligatory, that are called voluntary disclosure. So what are they? Then we'll be looking at the governance side of business reporting, and we'll be talking about the requirement for disclosure about corporate governance, the requirements in your country. We'll be looking at requirements in European Union, also just like in the case of Nigeria, the requirements of corporate governance. We'll be looking at management's commentary, and when we're talking about, we need to define it and what's the purpose of management commentary. Don't forget, the director has their own commentary, then management has its own. Then we'll be looking at IFRS practice statement on it, on management commentary. We must report on risk too. So risk reporting, what is risk management? We must understand the situation of risk as it relates to our organization, as it relates to our country, as it relates to our industry. The component of effective risk reporting, and we are going to cite example and learn from UK experience. Then we'll be talking about other financial information that should be in the annual report, looking at financial summary, financial highlights, key performance indicators. We are going to be mentioning the trend and trend analysis and the like. Then we are looking at the beyond reporting, beyond financial reporting as a topic. And when we are talking about beyond financial reporting as a topic, we'll be looking at the corporate social responsibility. We'll be looking at sustainability reporting. We'll be looking at integrated reporting. All these things, items look similar, but they actually cover different aspects of reporting. So what are they? Corporate social responsibility, will introduce ourselves to it, then we'll look at corporate social responsibility of the organization that will belong to or may belong to in the nearest future. Reporting requirements for social responsibility, and I tell you, not all countries are yet to be there when it comes to regulation about social reporting, but we will look at them, the reporting requirements for social responsibility reporting. Voluntary corporate social responsibility reporting, which we call voluntary CSR reporting. Then consequences of poor track record on corporate social responsibility issues as it may relate to different organizations. Then when we're talking about sustainability reporting, we are talking about what is sustainability itself, what is sustainability reporting, what is the word saying when it comes to global reporting initiative under sustainability reporting. We'll be talking about the Sustainability Accounting Standard Board, which we call SASB. Then other matters that we can discuss as it relates to sustainability, accounting, and reporting. Integrated reporting. What is the framework of integrated reporting? The code and the like. What is the definition of integrated reporting? Then we move on to IAS 8, which discussed accounting policies, change in accounting estimates, and measurement of errors. So the accounting policies, we talk about what are accounting policies. How can we select accounting policies that are most suitable for our organization? Don't forget, at this level, we decide all those things. And the danger of accounting policies is it cannot be changed easily once we set on to use them. Changes in accounting policy, then the retrospect application of a change in accounting policy, limitation of retrospective application of accounting policy, and the disclosure of a change in accounting policy if there is any. Accounting estimate, will talk about change in accounting estimates, disclosure requirements, and how to estimate in this profession accurately or free of biases. Let me use the word free of biases than accurately, because an estimate could not be actually accurate. Then when we're talking about error, under this topic, we'll look at the correction of error, prior year adjustments, and how to journalize. At this level, we must be able to journalize. What are journal entries? How can we do journal entries? What are the procedures for journal entries? And what are the approval stages necessary for correction of error? Limitation of retrospect restatement will be looked at, and the disclosure of prior period errors and how to manage it in the current financial statement will be looked at. Then when we are talking about judgments, like as we are talking about accounting estimates, it comes with judgments, and IAS 8 deals with it. Areas of judgments and estimates. Moving on, the impact of differences in accounting policies. And we are going to be talking about creative accounting and earning management as we introduce ourselves to the impact of differences in accounting policies. We are going to talk about what fair presentation is, the mechanism to reduce the problem of fair presentation, creative accounting and earning management. What is creative accounting? Earning management, how can we manage our earnings? Revenue recognition, when can we say we actually earn and could record revenue? Asset recognition, liability recognition, reducing current year period profit. And that's creative accounting there. Creative accounting techniques, we need to learn about window dressing, we need to learn about off-balance sheet items or off-balance sheet finance, we need to understand about profit smoothing, capitalizing expenses, and we need to know changes to accounting policies and accounting estimates, how we can use it for creative accounting. Is creative accounting actually ethical? Let us know your opinion about that in the comment section. Moving on to IFRS 15 on revenue from contracts with customer. We are going to learn about the 5 steps model of revenue from contract. We are going to learn about and understand factors that affect transaction price or transaction pricing. What does IFRS 15 has to say, and some specific example to guide us. When we are talking about the 5-step model, we'll be talking about identity of contracts, or how to understand and identify when we actually have a contract with a binding contract, for that matter, with a customer. Identify the separate performance obligation. What is the contractee and contractor obligation in the contract? Determination of transaction pricing, allocation of transaction price to performance obligation, recognition of revenue as at when the entity satisfies itself or herself about performance obligation. Those are the 5 just for you. Then we dig deep into it later. Factors affecting the transaction pricing, the variable consideration, the financial components, and we are going to break them down. These are the things we must learn under corporate reporting. Other aspects of IFRS 15, we are going to be discussing presentation, amortization, and impairment costs to fulfill contracts, contract costs as a general. Specific example, we will look at consignments, sales, bill and hold sales. We are going to look and touch on sales with a right to return, repurchasing agreements, the principal versus agent consideration under revenue from contracts with customer. When we are talking about the next topic, which is on non-current assets and non-financial liability, we must learn about PPE, property, plant and equipment, investment property. What's the difference between PPE and investment property? We need to understand intangible assets. We need to understand provision, contingent liability, and contingent assets as it relates to IAS 37. When we are talking about PPE, property, plant, and equipment, we must be able to define it, and that definition actually differentiates between property, plant, and equipment and investment property. So we cannot afford not to be able to define it accurately as expected. Then we must learn what is initial recognition, initial measurements, subsequent expenditure, and how we can put it together under PPE. We need to know measurements after initial recognition and where judgment comes in as it relates to PPE. We need to be able to define what an investment property is under investment property, how to account and the accounting treatment for investment property, especially under IAS 40, and where judgment of the professional comes in. Intangible assets, recognition and guidance for internally generated intangible assets. That is, those that we created within or we create within our organization. Extra guidance for intangible assets acquired. Those one that we purchased and maybe they are in little items, we need to break them down for the purpose of accounting treatment. Measurements after initial recognition, amortization of intangible assets, and how our judgment will come in. Provision, contingent liability, and contingent assets. So we must be able to define them very well. We must be able to measure very well. We must be able to provide for them in the financials and specific guidance on their provision. We must learn and know about contingent liability and contingent assets. Impairment of assets. So what is impairment? Cash generating units. What is cash generating units? We need to be able to answer it. Other issues where judgment comes in. So as it relates to impairment of assets, we need to understand IAS 36 very well. We need to be able to identify impairments. We need to be able to measure it and understand recoverable amount, accounting treatment for impairments, cash generating unit, and how to allocate an impairment loss to assets of each cash generating unit. Other issues that surround IAS 36 in form of reversal of impairment loss, disclosure requirements, and where judgments must come in as it relates to impairment of assets. Now we are looking at non-current assets held for the purpose of sales or held by discontinued business operations. And when we are talking about this, we need to know sales of non-current assets and how it relates to IFRS 5, classification of non-current assets, group disposal of assets held for sales, measurement of non-current assets and their classification, presentation and disclosure, and how to deal with assets of a discontinued business operation. Then where judgment comes in as it relates to IFRS 5. These are the jugglers we need to learn under this topic, and when we move on into the breakdown under this topic, we will be looking at the measurement of non-current assets, and under that we must know the allocation of an impairment loss in the books, subsequent remeasurements should in case, change to a plan of sales, we must understand and be able to process it in our financials. We must understand the general rule on the recognition in the accounts and assets that are held for sales. We must understand the objectives of IFRS 5. Asset to be depreciated, asset not to be depreciated, the fair value measurement, and the like. Classification of non-current assets. What are the rules that we must abide with or abide by? The criteria and the sales expected in over 1 year. Leases under IFRS 16. We must know what lease accounting is and how to prepare it. We must know reassessment and modification in leases accounts. Under lessors accounts, we must know how to classify lease, how to account for lease in lessors accounts, sales and leaseback transaction, and how to treat them both in leases and lessors financial statements. So we must know what the stand of IFRS 16 in these regards: the commencement, the inception, how to identify a lease, the lease term, the lease agreement, lease payment, residual value of lease item, interest rate implicit in the lease, and how to treat every one of these items under IFRS 16.